Hi friends, my name is Nilesh Phadke, your learning partner in finance and accounts. In this video, we will learn mainly about the preparation of the profit and loss account and balance sheet and the associated journal entries. Whenever businessman starts any business, he makes sales, incur expense, and at the end have some profits from the business. This is basically recorded in profit and loss account of the statement. At the same time, he takes bank loan for the business, make investment in FDs or other assets, also buy some computer and equipment, plant and machinery for the business. All these transactions are recorded in the books of accounts in the form of journal entries. So let's understand how to file journal entries and prepare profit and loss account and balance sheet with an example. So here we go. Purchase computer from Brijesh of rupees 30,000 at 18% GST and paid by check. GST stands for Goods and Service Tax. Now, computer appears on the balance sheet asset side. So it is 30,000 rupees and 18% GST. GST is basically split into two parts, central GST and state GST, 9% each. So input CGST, that is central GST, 30,000 into 9% is 2,700. And input HGST, that is state GST, 30,000 into 9% is equal to 2,700. And same is paid by check. So bank account will reduce, or rather bank balance will reduce by 35,400. That is 30,000 for computer plus 30,000 into 18%. So 30,000 plus 2,700 plus 2,700 minus 35,400. So total asset is 0 and total liability is also 0 and our balance sheet tallies. Now from bank balance 35,400 has gone, out of which 30,000 is paid towards computer and remaining 2,700 plus 2,700 is basically receivable to company from government. So input GST appears on asset side of balance sheet as it is receivable to us from the government. Now journal entry. Computer account will be debited by rupees 30,000 based on the rule of assets increases debit. Input CGST will be debited rupees 2,700 based on the rule of aid, that is assets increases debit. Input HGST will be debited by rupees 2,700 based on the rule of assets increases debit. And to bank appears on the balance sheet asset side, which is reducing. So rule is ARC, that is ARC, that is assets reduces credit. So 35,400. Narration is being computer purchase for rupees 30,000 plus 18% GST paid from bank balance. So total of debit side is 35,400 and total of credit side is 35,400. Thus we have passed the necessary journal entry. Purchase goods from Ram on credit of rupees 50,000 at 18% GST. Now in profit and loss account, purchase will appear on the expense side, rupees 50,000. That is purchase amount. Due to which total expense is 50,000, profit, that is A minus B, is minus 50,000. Assuming it to be first year of operation, there is no opening profit and hence retained earning is also minus 50,000, that is C plus D. Now this retained earning appears on the balance sheet liability side. So it is minus 50,000 here from P&L above. And since it is purchase on credit, there is no immediate cash outflow and thus RAM creditor is created to the extent of 59,000, that is 50,000 plus 18% GST, as the amount is payable from whom company is making purchases. Now input CGST, central GST is 50,000 into 9%, 4,500, and input HGST is 50,000 into 9%, 4,500. This 18% is split into two parts, 9% for input CGST is central GST and HGST is state GST. So total liability is 9,000 and total assets is also 9,000 and our balance sheet tally. Input GST appears on asset side of balance sheet as it is receivable to us or company from the government. As this 9,000 we have paid for purchases related to the tax amount and not the actual thing amount. Now let us pass necessary journal entry. Now retained earning is reducing by rupees 50,000. So rule is LRD, that is liability reduces debit 50,000. However, whenever journal entry is passed, you do not directly write the word retained earnings. Rather, you write a transaction which is affecting this retained earning, that is purchases in this case. You can check here in profit and loss account. Now input CGST, assets increases debit and hence 4,500. Input SGST, assets increases debit 4,500. Now RAM creditor appearing is on balance sheet liability side. So and it is increasing by rupees 59,000. So rule is LIC, that is liability increases credit rupees 59,000. So total of debit side is 59,000 and total of credit side is also 59,000, and we have passed necessary journal entry related to being purchases from RAM on credit with GST of 18%. Thus we have passed necessary journal entry. Purchase goods for cash rupees 50,000 at 18% GST less 10% discount. So in profit and loss account, purchases is basically recorded to the extent of 50,000 and discount received is 50,000 into 10%, that is 5,000, which is basically a total income. So total income 5,000, total expense 50,000 and thus profit or loss is minus 45,000. There is no opening profit, so retained earning is minus 45,000. Thus the retained earning from P&L above is minus 45,000. Now cash gone out is 50,000 ideally for purchases of the goods, but there is a 18% GST. So 18% of 50,000 minus we got 10% discount. So we have not paid the entire amount, but only after deducting a discount of 10% of 50,000. So net cash outflow is minus 54,000. And input CGST, that is central GST, 50,000 into 9% is 4,500, and input SGST, that is state GST, 50,000 into 9% is 4,500. So total liability side is minus 45,000, total asset side is minus 45,000 and our balance sheet tallies. Now input GST appears on asset side of balance sheet as it is receivable to us, that is company from the government. Now here we have made a purchases to the extent of 50,000. So retained earning due to which is reducing to the extent of 50,000 from these purchases. So rule is liability reduces debit, but instead of retained earning while passing journal entry you will write the word purchases and hence purchases is 50,000. At the same time, input CGST, assets increases debit 4,500, input SGST, assets increases debit 4,500. However, cash gone out to the extent of only 54,000, that is after discount. So rule is ARC, that is assets reduces credit. So cash 54,000 and at the same time company has received a discount of 50,000 into 10%, that is 5,000, due to which retained earning is increasing to the extent of 5,000. So liability increases credit is the rule, liability increases credit. So retained earning will be credited. However, whenever retained earning is affected, you do not directly write the word retained earning, rather you write the word a transaction which is resulting into this retained earning increase, that is discount received to the extent of 5,000. So being purchases of goods for cash with 18% GST and 10% discount. So total of debit side is 59,000 and credit side is also 59,000, and thus we have passed necessary journal entry.
Thus, to conclude, what we can say is that as a first step, you have to identify whether the item appears in profit and loss account or balance sheet. Once you identified this, based on the rule of AID, ARC, LIC, LRD, you can pass any type of journal entry. So first rule is AID, that is assets increases debit. Second rule is ARC, that is assets reduces credit. Third rule is LIC, that is liability increases credit. And fourth rule is LRD, that is liability reduces debit.